Let's talk markets and elections. Obviously, it's a topic that is bound to come up more and more between now and November 5th. It's a topic of conversation that's a big one every 4 years for us with clients and prospective client families. And I'd love to sort of sift some fact from fiction. To me, a lot of the conversations are more fear based than reality based on historical trends in markets. So, let's dive right into it. What I'm sharing is basically tracking the S&P 500 index and its performance specifically in election years. And one of the things that you'll note right off the bat, just on the left-hand side, the averages around when a Republican was elected versus a Democrat versus all election years. So measuring basically large U.S. stock performance in election years for a Republican was 15.3% on average, a Democrat 7.6, and if you combine all election years, 11.28%. What I have pointed out in multiple conversations over the last few months with clients is a stat that I really like, which is that in the last 23 elections, dating back to 1928, in 19 of those, the S&P 500 index stocks in the U.S. were positive to finish the year in those years, which means there have only been four periods during election years where U.S. stocks have retreated. Now, that's not to say other parts of markets can be affected of an interest rates in the bond market, but just looking at U.S. stocks for a minute, those four periods, to point them out specifically, most recently was when President Obama was elected in 2008. Markets sold off quite a bit. However, if you'll remember, 2008, we were dealing with the Great Recession, the financial crisis. So to me, the economic environment was very volatile for stocks and had much less to do with President Obama coming into office. Ditto, if you look at when President Bush was elected in the turn of the millennium, year 2000, we had the dot-com bubble upon us. So stocks were extremely volatile during that period as we had the dot-com bubble burst a little bit. The other two periods out of those 23 where stocks were negative were back in 1940 when President Roosevelt was reelected, and also 1932 when President Roosevelt was originally elected. Both of those election periods correlate with the onset of World War II and 1932 coming out of the Great Depression. So, being the throes of other economic and geopolitical turmoil events, to me, bigger attributing factors than the election was itself. Just to share a couple other pieces of information that I thought was really interesting from some of the research we've been reading is how that same S&P 500 index performed over a long period of time when Democrats versus Republicans were in the office, and a couple other items. So this slide is mentioning if you invested $10,000 in 1950 and you kept your money invested through September of 2024, so really through present times, your dollars would have grown, your original investment would have grown to about $3.5 million, which is what's in this gray line here. Now, if you compare that to only being invested during Republican presidencies, your $10,000 would be worth a measly $78,000 versus that 3.5. Ditto, being invested during only Democratic presidencies, your money would be worth about $445,000. So paling in comparison to simply staying the course and being invested throughout all periods. Now, one fair argument against some of the rhetoric I'm providing in this video is, what about volatility around the election? And certainly there has been volatility around the election. This slide mentions there has been some heightened changes to the stock market during election days in the last couple of decades, dating back to 1992 on average. However, most of that volatility does start to dissipate in the days, weeks, and months following it. As you get towards Inauguration Day, on average, things have fizzled out a little bit as well. Just one last slide I'll share here as well, similar to the last one, that looks at a $10,000 investment dating back to 1950. If you, in election years only, decided to move your stock portfolio investments to cash, you would be at a $979 or $80,000 portfolio value versus staying invested in stocks that entire time. you'd be at that $3.5 million number as well. So just to show to stick with the strategy, your investment strategy that is prescribed for your financial plan is often the most paramount thing you can do versus going to cash, letting partisan opinions start to shape your philosophy around your portfolio. So I hope you found this helpful. And if you have questions, please reach out. Thanks.